joining us today.
We are joined today by Maurice Oduor, who is a senior manager at Genghis Capital, and he will be talking about investing in the fixed income. I can see we are many on board, so yes, let's learn. Maurice, over to you.
Thank you, Rose, and thank you everyone for joining into this webinar. We are going to just get a common understanding in terms of what fixed income instruments are and how they behave and how you are supposed to approach them when you want to tap into the investment opportunity in the fixed income space, and also the key items that you should be aware of when you are moving into that investment space. So I'm going to go through the slides. Sorry, Rose, there's an issue. The slides are not moving.
Oh, it's okay. It's on your end?
Yeah, I have it here, but I've shared, but now when I'm trying to go through the slides, let me stop and I share again.
Okay, no worries. Please be patient with us. Also, as Maurice shares the slides, kindly keep the questions coming. We shall address them at the end of the session. You can type them in. If you have to talk through, raise your hand, we unmute you, and then we can address them at the end of the session. Asanteni sana.
Now, everyone can see?
No.
Technology.
Always.
Now?
Now we can see. Yes.
Sorry, that's our technological issues that we are now grappling with in this era of COVID-19. So, what are fixed income instruments? That's the first question that we need to answer today. These are investment opportunities that pays investors in terms of a periodic income payments, which are called in fixed income environment, they are called coupon payment. Commonly, people refer to them as interest payments, and also principal payment at maturity. What we mean is that if, for example, you invest 1 million Kenya shillings in let's say a given bond, paying interest, let's say, for example, at 10%, this instrument will be paying you interest income or coupon periodically, let's say semi-annually, quarterly, or annually. Then at the end of maturity, the end of the tenure of the instrument, you will be given back the 1 million Kenya shillings. So 1 million Kenya shillings, for our example, is what we call the principal. And the periodic payment is what we call the coupon payment. So those are the basic sources of returns when you invest in cash inflows, when you invest in a fixed income instrument. We call them fixed income because in most cases, the periodic coupon payment is usually fixed. Though of late, there are also variable coupon payment instruments in the fixed income space that attach coupon payment, levels of coupon payment to a given specific instrument that will determine how much you're supposed to be paid. And also what we realize also when you get to these floating variable coupon rate instruments, also coupon rate is set in advance. Again, which means for a given period of time, the coupon rate is still going to be fixed. You know what you are going to earn for a specific period of time. So they are mainly money denominated. When you are talking in terms of investing in fixed income instrument, you are talking in terms of money that you are going to invest and putting it away. And again, the same money is what will come back to you after periodic coupon payments. So given that they are money-denominated instruments, they have low capacity. Most cases, they usually have low capacity to outperform inflation rates. The reason why I'm saying this, for example, if you invest in a 30-year, you put $1 million Kenyan shillings in a 30-year government bond, it means government will pay you coupon payment periodically for the next 30 years. At the end of 30 years, they'll give you back the amount of money you gave them, which is $1 million Kenyan shillings. So you put away $1 million Kenyan shillings, they pay you periodic interest payment, then at the end, they give you back $1 million Kenyan shillings that you gave them. Then, as we already said, there are two sources of cash flows in this. There are coupon payment, and also the principal or the notional amount that you'll be paid at maturity. So basically, those are what fixed income instruments are. They are simply debt instruments, or in other terms, you can even call them, they are simply loans. Because when you are giving government issuing a bond, what you are simply doing, you are loaning government money. Then they service you, then they pay you the principal at the end of the investment tenor for that specific instrument. Types of fixed income instruments, they usually can be grouped based on different facets. The first category, you can look at them based on the issuing entity. Under this, fixed income can either be corporate instruments or government or treasury instruments. Corporate instruments are issued by private entities. Let's say, for example, ABCD Limited want to raise money in a debt market. They want to raise money for 5 years. They can choose to issue a 5-year bond. That bond now is called a corporate bond. For government, wants to raise money, let's say for 10 years, they're issuing a bond. Now that bond you call it a treasury bond or a government bond because the issuing entity is the government. On the other end, we call them corporate bonds because the issuing entities are private corporate institutions. So the first classification is based on who is issuing the bond or who is issuing the instrument. The second category is based on the nature of the coupon itself. We've already mentioned in the previous slide, coupon can either be fixed or floating, or even some instrument issue zero coupon bond, some instrument issue deferred coupon bond, or some instrument also issue step-up coupon. Fixed coupon, it means for the entire period of that instrument, that interest already been determined and it is fixed. It cannot change irrespective of whatever happened in the interest rate environment. For example, a government bond issuing a 10-year bond with a coupon rate of 12%, it means for the next 10 years, you'll be paid coupon at the rate of 12% per annum. Even if rate goes to 30%, you will be paid at 12%. If rate goes to 2%, you will be paid at 12%. Floating rate coupon bonds, these ones, they pay coupon changes based on the prevailing economic environment. What most issuers do, they identify what we call the basis. The basis means the platform upon which I'm going to price this interest at. Mostly issuers take 91-day T-bill or 91 or 182 or 364-day T-bill. Then they add on top what we call a margin. They can even say, I'll pay you at 91-day T-bill plus 4%, which now means if 91-day T-bill is at 7, you'll be paid at 11. 91-day T-bill is at 5, you'll be paid at 9. 91-day T-bill is at 12, you'll be paid at 16. They take 91-day T-bill, then they layer that margin on top of it. Those are called floating rate because the rate moves based on the performance and the level of the basis where the bond is being priced at, which is what we use for example. We said, for example, 91-day T-bill. Most issuers of such bond, they usually set what we call a ceiling and a floor. A ceiling means the highest point upon which I can't go beyond. A floor means I can't pay you lower than this. So floor are meant to protect investors. Ceiling are meant to protect the issuer. For example, 91-day T-bill, and we are saying a margin, basis 91-day T-bill, we are saying a margin is 4%. If 91-day T-bill goes to 6%, I'll be paid at 10. Then now the issuer can say, we'll have a floor at 5, and we'll have a ceiling at 12, which now means if 91-day T-bill goes to 10, we have a margin of 4. So 10 plus 4, you're supposed to be paid at 14. Yet the ceiling is at 12, so now you'll be paid at 12. Or floor, let's say floor is 5, 91-day T-bill, let's say, is at 0.5. then 0.5 plus 4 is supposed to be 4.5. You're supposed to be paid at 4.5. But because the floor is at 5, you'll be paid at 5. So floors protect investors, ceiling protect the issuer. The maximum maximum level that issuer cannot pay more than that. Ceiling is the lowest that an investor stand to get in any if the interest rates are too low. That's how floating rate bonds operate. Zero coupon bonds here, the issuer will issue a bond that will not pay any interest for its tenor. I know the question that comes is then how will investors make money if the bond itself is zero coupon, which means not paying coupon? Such bonds are usually issued at a discount. A discount means the par for the bond can be 100 shillings, but I'll say I will give you at 95. So you buy what is worth 100 shillings at 95, which now means that discount is what you'll get as income for the life of the bond, and you'll get at maturity. At maturity now, you gave me 95, I'll give you back 100. So 5% will already compensate investors in terms of income. So that's how zero coupon bonds operate. A typical instrument that operates like a zero coupon bonds in Kenya is treasury bills. Treasury bills don't pay periodic interest, coupon payment. They're basically issued at a discount, and what investors stand to get is the difference between the price I'm paying and the price at which will be redeemed at the end, which is usually at par. Then we have deferred coupon. Deferred coupon bonds, these are bonds that, let's say, coupon are deferred for a specific period of time. Let's say I'm issuing a 5-year bond. Then I'm saying for the first 1.5 years, the bond will not pay interest. Then from thereafter, it will start paying, which means I've deferred payment of coupon. Then now how the issuer is started along the way, there's a way how I'll be compensated for the days that the interest was deferred. So that now means I was not paid. Those are called deferred coupon because simply coupon has been deferred and supposed to pick up from a specific along the way as the instrument approaches maturity. The last one we call step-up coupon bonds. Step-up coupon bonds are bonds where the coupon will be progressively increasing. Can start, let's say, at 10%, and you say after year 2, we'll go to 10.5. After year 4, we'll go to 12%. Those are step-up coupon bonds. Common instruments under this category in Kenya is fixed income, fixed coupon bonds, floating coupons bond, and zero coupon bonds, but mainly now the instruments that operate in the zero coupon bond manner are the treasury bills that are issued by government on a weekly basis. The third category of classifying fixed income instrument is the redemption method. Redemption means how will I get back my principal? So here, bonds can either be amortizing or bullet. Amortizing means progressively along the way I'm being paid back my principal. Bullet means I will sit and wait to get principal payment once at maturity. That's a bullet. Amortizing means, for example, if I've invested 1 million shillings, we'll say at the end on a 5-year instrument, you can say at the end of year 1, I'll pay you 20% of your principal. At the end of year 2, I'll pay you another 20%. At the end of year 3, I pay you another 20%. At the end of year 4, I'll pay you another 20%. So now at the end of year 5, I'll pay you what's outstanding, which is again now the last 20%. That is called amortizing bonds. Bullet, end of year 1, I'll only pay you coupon. Year 2, I'll only pay you coupon. Year 3, I'll only pay you coupon. Year 4, I'll only pay you coupon. Year 5, I'll pay you the last coupon plus the principal. That's bullet. So bullet, entire amount at the end. Amortizing, progressively, I'm being paid by a portion of my principal as the bond approaches maturity. The fourth category, you can look at it in terms of tenors. Tenors, these instruments are either bills or commercial papers or bonds. Any fixed income instrument with a maturity of 1 year and below is either called a treasury bill or a commercial paper. A treasury bills are issued by government, commercial papers are issued by private entities. Any fixed income instrument with a tenor of more than 1 year is called a bond. It can either be a treasury bond or a corporate bond. Treasury issuer, we go to the first point, issuer is the government. Corporate issuer is a private entity. Then the last category for now that again can use to classify fixed income instruments is based on option that has been attached to that instrument. On this instrument, instruments can either be option free or callable or puttable or convertible. Option free means no any other structure has been layered on that instrument. It's purely as it is. A 5-year bond paying coupon at 12%, for example. Plain, just like that. A callable bond is a bond where now the issuer will say, I'm issuing a 5-year bond that will pay coupon at 12% per annum, and the coupon will be paid semi-annually. But from year 2, I have the right to recall this bond if I want. That's called a callable bond. It gives the issuer the right to redeem, to call back the bond and pay the investor money. So what usually happens is that callable bonds are issuers usually call them when interest rates are very low. They recall them, then they reprice at a low interest rate environment. A puttable bond is now the opposite of a callable bond. You issue a bond, then you put a put option. A put option gives the investor the right to put back the bond, to give the bond back to the issuer. It's like you are forcing the issuer to take the bond. So puttable bonds exercised, put is exercised by the investor. Call is exercised by the issuer. Put will be attractive in a high interest rate environment where I'm holding a 5-year bond giving me interest at 12%. Yet in this environment, a 5-year bond is paying 15%. What I will do, I will put the bond back to the issuer, I get back my money, and I reinvest in high interest rate environment. The last one under this is convertible bonds. Convertible bonds are bonds that have an option attached to them, and that when a given trigger point is reached, investors can choose to convert them into equity investments. So they are pseudo-equity instruments because the value, the investor is cleanly monitoring the equity, the share price of this specific entity, and monitoring where the trigger points have been reached, continue evaluating and see, is it attractive for me to convert or not? Those ones are called convertible instruments. So 5 major classifications based on the issuer, based on the type of coupon, based on redemption method, based on the tenor, and also the option that has been attached to that instrument. We now look at government issued fixed income securities. We've said can either be a treasury bill or a treasury bond. A treasury bill is any fixed income instrument issued by the government that has a tenor of more than 1 year. For example, government issuing a 5-year bond, that's a bond. Government issuing a 10-year instrument, that's a bond. On the other end, treasury bills, any instrument issued, fixed income instrument issued by the government with maturity of less than 1 year, 1 year and below, that's a bond. That's a treasury bill. Examples in Kenya, 91-day, 182-day, 364-day treasury bills. Those are examples of bills that are issued by the government. So that's the main distinction. For treasury bills, they are mainly zero coupon. They don't pay in coupon payment. Treasury bonds, they are coupon instruments. They pay coupon periodically. So treasury bills all must be issued at a discount for it to make economic sense to an investor. Treasury bonds can take whichever form, can be at a premium or at a discount, which we'll get into the next slides to come where we'll get into it in details. Advantages of government issued fixed income instrument is that the levels of defaults are usually low because people have faith with the government. I know you've heard people saying, where is the government going in the next X number of years? Because they have faith in the government will never default. That's number one. Number two, they have periodic cash inflows in terms of coupon payment for bonds. Liquidity, they are easily transferable to an investor who wants to exit before maturity. For example, I'm holding a 5-year bond. Along the way after year 2, I need money. This bond is not puttable. I can't put it back to the issuer. The only thing I have, I can now go and sell this bond in the secondary market. So in Kenya, there's a very robust and a deep secondary market for fixed income instrument, especially government issued. So you can go and sell it there. So there's liquidity, there's regular income, default is significantly lower because of the entity standing behind the instrument, which is the government. The major disadvantage is what we call the interest rate risk. Interest rate risk means in fixed income, the value of an instrument is usually inversely related to the level of interest rates. When rates goes higher, my bond valuation goes down. When rates are low, the bond valuation goes up, giving now what we call in fixed income portfolio management, bond duration, which affects the return that you'll stand to get as an investor. And this is mainly because these instruments are traded and they are subject to the prevailing interest rate environment that dictates and determines their pricing. That's the major disadvantage of government securities. We look at the next set of the instrument, which is corporate issued fixed income instruments. These are corporate bonds. Corporate bonds, maturity has to be more than 1 year. And as we said, these are purely debt instruments or loans that you are giving money to a specific company to run their affairs. As they do that, they pay you coupon payment, and at the end of the maturity, they pay you back your money in terms of the principal that you put in. Advantages for this instrument, they are in terms of return, they are mainly usually priced at a premium compared to government bonds. Similar instruments, let's say a 5-year government bond and a 5-year corporate bonds cannot earn the same because the entities standing behind all these two instruments are different in terms of risk profile. So a 5-year corporate bond must earn higher than a 5-year government bond for it to make sense, because the faith that you have with the government and the faith that you have with the private entity, you are more comfortable with the government and you are likely to demand lower compared to what you'll get, what you'll demand from a private entity. So they are, in terms of return, they're actually priced slightly at a premium compared to government instruments. Also, they pay regular inflow in terms of coupon payment. Then they're usually classified higher in terms of the subordination classification of the balance sheet. And some bonds may also give investors opportunity to tap into, to convert their investments into security equities for that specific entity, which is the issuer. For example, ABCD Company Limited issuing a 5-year bond, but convertible after, let's say, from year 2 at a specific price. So investor has the leeway to decide, moving it to equity, is it making more returns for me as opposed to sitting with it as a bond? Then from there, they make the decisions. Disadvantages, the levels of default are higher compared to government instruments. Also in Kenya, in terms of liquidity, these bonds are difficult to sell because in Kenya, the debt market, the fixed income market for corporate, we don't have a robust and a deep fixed income market for corporate instruments. Most of them, people hold to maturity because the opportunity to sell are usually rare in this market. Again, another set of corporate instruments are commercial paper. This one we said is fixed income instrument issued by the private entity, but with maturity of 1 year and below. Mainly, they are issued at a discount, but in Kenya of late, we've seen corporates issuing them at par. And again, now just paying you interest. So typically, they behave like how banks deposit operates in terms of income. They are called their add-on instrument because I'm giving you $1 million, pay me my very frequent my coupon, then along the way at maturity, give me back my 1 million plus my return. Then tenor, there's a great levels of flexibility in terms of commercial papers market, in that issuers can structure 30, 91, 182, 364 year, even for the same specific issue. They're able to issue and blend in terms of different tenors. So investors have leeway in terms of picking which level do they want to play at. So that flexibility is there. Disadvantages similar to corporate bonds, levels of default. And also you can't, whatever instrument that is comparable to a commercial paper for a treasury instrument are treasury bills. People have faith with the government, and hence levels of default for government is usually lower, and people tend to demand lower for treasury bills. When I'm moving my money now to do a commercial paper, I will have to demand higher because chances of default, probability of default is higher for a private entity. Liquidity, these instruments are illiquid. You can't sell, most of them are usually not even transferable. So that's a decision that you carry when you invest in commercial papers, which are a subset of corporate issued fixed income instruments. Another one is just pure bank deposit. These are just money that you place with banks. Again, here now the levels of flexibility is where you can't even compare to any other instruments. You can do call, you can do 1 month, you can do 2 months, you can structure whatever tenor that you want that suits your investment horizon. They're usually regarded as safe because banks are among the most heavily regulated institutions in Kenya. So people tend to be comfortable with putting their money in banks, especially with a given types of level of banks that are called tier 1 banks. Again, these are just loans that you are giving to the government, to the bank, for the bank to run their affairs, then they pay you back your money and also plus the returns. Disadvantages, majorly the interest rate usually tend to be very low. Minimum investment tend to be very high. If you have, for example, 100,000 Kenya shillings, when you go to place a deposit, banks will not even pay attention to you. But you can get a commercial paper instrument where you can even bid with minimum investments 100,000 Kenya shillings. 100,000 Kenya shillings, you can participate in a government bond auction. 100,000 Kenya shillings, you can also participate in a treasury bill auction for the government. So that is the advantage of bank. But they mostly wholesale. They'll need significant amount of money for them to be able to accept and also take your money as deposit. Liquidity, mostly, especially fixed banks, will even penalize you when you want to recall before maturity. That's a disadvantage. Then also, as much as people are comfortable with banks, as much as the banks are one of the most regulated institutions, the chances of default are also there. And I think in Kenyan banking space, over the last 3 or 4 years, we've seen such. So those are the disadvantages that you carry when you decide to play within the bank deposit as the subset of the fixed income instruments that you want to play to put your investment in. The third thing that we need to look at today, again, is how to invest in fixed income instruments. You can do it in 2 ways. Number one, I can choose to go directly. Directly means government is issuing a bond. I'm going there as Maurice, I'll open my CDS account and buy the bond. The bond sits in my name. That I'm going directly, I'm getting the specific instrument. Number two, you can do it indirectly by investing in funds that predominantly invest in fixed income instruments. A very good example, money market funds and bond funds. Here, you are not holding the instrument. The instrument is not in your name, it's in the fund. But the benefits and the return that I'm getting are derived from fixed income instruments. Those are 2 major ways which you can do them. Direct investments, as I've already said, means you have to open what we call a CDS account with the fiscal agent for Kenya. If you're doing treasury bonds for Kenya, which in this case is the CBK. You have to open a central bank CDS account with the CBK where your bonds will sit in. Then for treasury, the auction for TB is usually on a weekly basis, and the auction for treasury bonds is usually on a monthly basis. Every month, the government will float a bond, and every week, the government will float 91-day, 182-day, and 364-day instruments for investors to bid. And the most transparent and the most democratic process of the process of investing is usually in this auction market. You say what you want, then the government, the issuer decides whether they are comfortable with giving you at the price that you want. That's why I usually hear people saying my bids was not successful, because maybe the returns that you wanted, they are not willing to give you that. So you say what you want, then they decide whether they'll give you at the price that you want to take it. Then investors, when they place the bids, what they specify is the rate or the yield. And this determines the pricing that you're going to purchase the instrument at. For corporate instruments, there are no specific calendar that we follow to know that now on this date, ABCD Limited will be floating a commercial paper. They are more ad hoc and they come as on need, and as they come when the issuers are there and the issuers need to raise money from the market. So government, more structured, we know every week, 91 day, 182, 340 days will be auctioned. Every month, a bond will be floated. On corporate side, it's not known. Maybe sometimes you are sitting here and someone is structuring a corporate bond, we don't know. Or maybe you're still here and yet you're supposed to go even up to next year, no bond will be issued. Also that one, we don't know. So those are now the two things. You can choose to invest either directly or indirectly. Once you do directly means you are in your own hands. You'll have to know when the auction is there. You'll have to be familiar with the operating environment. You'll have to know where, if I need to be at what level for me to be able to be successful. That indirectly, I'm handing over all those duties to a person that will be doing all those. Me, what I want is a return. I don't want to own the bond. What I want to get is a return that is derived from fixed income instruments. The next one is we look at now, how do we price fixed income instruments? Two things that we need to be aware of. There's what we call yield to maturity and coupon rate. Then the second one, what we call clean, dirty, or full price or accrued interest. Yield to maturity is the return that I will get as an investor. If I bid for a bond and I'm putting my yield at 12%, if I hold this bond to maturity, let's say it's a 5-year bond, if I hold it to maturity, the return that I will get is 12%. That's yield to maturity. It's totally different from the coupon rate. Coupon rate is the periodic return that the issuer will be paying me as an investor. Let's say, for example, I'm buying a 5-year bond with a coupon rate of 10%, and I'm buying and I've gotten it at a yield to maturity of 12%. It means if I hold this bond for 5 years, my overall return per annum will be 12%. But periodically, I'll be paid coupon at 10%. That one will give us now to the next thing that I think is on this slide on item point number 3. Then before we get to point number 3, let's understand clean price, dirty price, and full price. Clean price is the expected future cash flows on the life on this instrument. I discount them back to present. That one will give me the clean price of the bond. Then on top of that, the last coupon payment to now, the day that I'm doing this valuation, some income interest has been accrued. So I already have two things. I have my clean price, which I've populated the cash flow from this instrument, and I've brought them to now. I have my clean price. The next thing that I'm saying, from the day this bond paid coupon, there are some coupons that have been accrued that have now ceased to be part of the future. That's now called accrued interest. So if I add accrued interest plus the clean price, I will get what is called dirty price, or the full price of the bonds. If you are an investor and you are trading bonds in secondary market, always ensure that you are trading at dirty price so that you will be compensated for the interest that the bond has accrued from the last time the bond paid interest and the time that you are now selling the bond and passing over the ownership and the economic benefit of this bond to the next person. Those are two things very key when you want to participate in a fixed income market. Let's go now to point number 3. When yield to maturity, which we are calling YTM, yield to maturity is equal to the coupon rate. For example, I'm buying a 5-year bond that has a coupon of 12%, and also I'm bidding at 12%, which means the return that I stand to get is 12%. I'm also going to get interest income at 12%. When such scenario occurs, we are saying this bond is priced at par, which now means if the par value for the bond is 100 shillings, I'm simply buying 100 shillings for 100 shillings. What will I get as a return is the coupon interest, which is now equal to the yield to maturity. So if you hold a par bond, if you hold a bond that you bought at par, hold it to maturity, the return that you stand to get is simply the coupon rate, which will be equal to the yield to maturity for this bond, for that instrument. The second category, the second scenario is a situation where my yield to maturity is greater, is higher than my coupon rate. A very good example, I'm bidding, I have a 5-year bond. My bid was at 12%, and this bond is paying interest at 10%, which now means for this bond, I will be if I hold to maturity, I will get a return of 12%. Part of this return of 12%, it means I'll be getting 10% from interest income, periodic coupon payment. I'm remaining with a gap of 2% to bridge for me to get to 12. And a scenario where yield to maturity is greater than coupon rate, that scenario we say the bond is priced at a discount. A discount means the bond is 100 shillings, I'm getting it at 95. So apart from the coupon that I will get, at maturity, I will also get the difference between the par and the price I bought it at, which is the 5 shillings. So that now bridges the 2% you are talking about. So yield to maturity greater than coupon rate, the instrument is priced at a discount. The third scenario is where yield to maturity is less than the coupon rate. A 5-year government bonds paying coupon at 10%, but me I'm bidding at 8. It means if I hold this bond to maturity, I will get a return of 8%. Part of this return of 8% will come in form of coupon payment, which for this case, it's coming in at 10%. Again, now I need to bridge the 2% to take me from 10 to 8. And a scenario where yield to maturity is greater is less than coupon rate, we say the bond has been priced at a premium. A premium means I'm buying, premium means if pi is 100, I'm buying this bond at 105. So 5 is the premium. At maturity, I'll be paid back at 100, which means I gave out 105 and I'm going to get 100. There I've already suffered 5. This 5 is what offsets and my interest income to come from 10 to 8, and 8 is the return that I'm going to get over the life of this bond, and all these rates are per annum. Key thing that you need to note whenever you are pricing a bond, a bond that is priced today, the price will be different tomorrow. Because as days are lapsing, as I'm continuing accruing interest, my full price for the bond changes on a daily basis. Because every day, some cash flows, future cash flows are coming out of the future and being part of the past. They go to the reserve of the accrued interest. And which now means the cash that I discounted today will not be the same cash that I'm going to discount tomorrow. They are different. So settlement date is very key. Settlement date is the day that I want this transaction to happen. and I pass over the ownership and the economic benefits of this instrument to the next investor. Then we've already said clean price plus accrued interest will give me the dirty price, which is the full price of the bond. You take what is clean, you add the interest, it will give you dirty price. It seems like this accrued interest is the dirty in this case. So that's how bonds are priced. We didn't want to get in the technical of doing the actual discounting, but the basic thing that you need to know your yield to maturity, you need to know your coupon rate, know your clean price, know your accrued interest, know your dirty price, then know different scenarios. When a bond is trading at par, what does that mean? Yield to maturity equals to coupon rate. When a bond is trading at a discount, what does that mean? Yield to maturity greater than coupon rate. When a bond is trading at a premium, what does it mean? It means my yield to maturity is lower than the coupon rate. Then always the reference point, look at the settlement date so that at least you get all benefit that have accrued on that instrument as at that settlement date, that you pass it now to the next person to take over, and also whatever accrues from there will belong to that that investor. Keynote thing that you need to be familiar with when you're investing in fixed income market: risk and returns. The higher the risk, high risk instruments tend to give higher returns. That's the reason, the main reason, that also in line with what we said earlier, that corporate instruments are usually priced at a premium because of the risk involved compared to government instruments. Investment horizon, longer dated instruments tend to pay higher compared to shorter dated instruments. If I'm investing in a 2-year government bond, another person investing in a 10-year government bonds, we can't get the same rate because the 10-year guy will have to be paid for the excess duration is taking over and above the 2-year instrument. So the longer the duration, the longer the investment horizon, the longer the tenor, the higher the yield should be. So when you are trading, also be aware of that. Ensure that how things are being, prices are being quoted compensates you for everything. Then liquidity, assess your liquidity as an investor, whether you'll be able to meet liquidity along the way. And if that will be the case, you need to invest in more liquid fixed income instruments, which are mainly government bonds that are tradable in the secondary market, and you can exit when the needs arises. Also be aware of your tax profile. Government bonds are usually either zero tax exempt, 10% or 15%. Zero tax infrastructure bonds, they are tax exempt. They don't pay any tax. 10%, any instrument that is more than 10 years in Kenya for government instrument, they will pay tax, charge tax at 10%. 10 years and below, you will charge at 15%. So know your tax status and your tax profile. That will dictate which aspects where you are going to play at in terms of the fixed income environment. Then also know that some of these systems are usually credit rated. Credit rated, which means there's an independent third party that will look at the company operation and tell you, in my view, having assessed all these things, these guys are investment grade, these guys are junk, or these guys are transitioning to a bad or a good territory. And all that even can inform your decision in terms of where you want to invest in. Then if you look at, always never invest in businesses that you don't understand. If you understand my operating model, it means you're understanding how my capability of being able to pay you. So even before you look at the instrument, understand how the issuer operates. Then that will inform how the issuer will be able, whether the issuer will be able to generate cash flow that will be sufficient to pay you. And at Genghis Capital, What we do, we offer opportunities for investors either to go directly into and bid for, get fixed access to fixed income opportunities, or you can do it through our funds that we have that are investing in fixed income space, which is mainly the money market fund that we call Hela Imara Fund. It's a money market fund. Money market fund by definition invests in fixed income instruments. So, and as per the recent CME guidelines, so long as the weighted tenor of all these instruments will not be more than 13 months. The advantage is easily accessible. Minimum investment is as low as 500 shillings. And whenever you want your money, it's like money on call. 2 to 3 working days, you'll have your money. And that's the end of the presentation I have for today. And I will hand back to the moderator.
Thank you, Maurice. We have a few questions that have come through. I'll just try to read them as they are so that we can be able to, and let me start with the one that has been asked most recently. How does the yield curve influence the bond auctions stroke bidding? What do you look out for when analyzing the yield curve on the secondary market to know how to bid?
So I answered this one first, or you give me like 3.
Yeah. Okay, let me give you some more. Just a minute. So there was another one. How is the client protected from rogue dealers, that is, or investment managers under the front running? Do you share market insights in advance with clients? The other question was, what is a green bond?
Green bond?
Yes. Then let me ask, there'll be a fourth one. What is your perspective in the next year under the current scenario?
Perspective as far as what is concerned?
I think investments. Admin, kindly elaborate on that. Yes.
Okay, you've given me 4, let me answer. Yield curve. Yield curve in the market, the secondary market, there are different instruments. And now what happens, this instrument trade at different yields. When you populate that, plot a graph, what you get is called a yield curve. So how this yield curve plays with the auction is that if the government is issuing a 5-year bond, in fact, the first reference point for you should be where the 5-year bond trading at in the secondary market. Where do you get that? You go to the yield curve. Then now you'll determine if a 5-year bond is at 12% in the secondary market, government is issuing. So it gives you an area where you should be that. Then factor that influence affects yield curve is purely investor sentiments, the interest rate environment, and people's expectation in terms of where the economy is headed in terms of interest levels. So yield curve is a very important tool for a person who wants to invest in fixed income instrument, and that's the beginning of everything. You go to the fixed income, the yield curve, look at where the tenor that instrument is trading, and then from there you price plus other market information. You see now whether you can bid higher than the yield curve or it will not be possible, which now means if not be possible, then you are better off getting the same instrument from the market. But people like new instruments because they are liquid, they are called on the run because they are the new ones. So attention will shift more towards them. Then how you protect investors from the rogue dealers and front running? Number one thing, always arm yourself with information. And that's the last thing I say. Don't invest in things that you don't understand. You can be a victim of other things that you didn't even expect. Arm yourself with information. Don't just do things because they are there. Do because you understand them. Once you understand them, no one can protect you like yourself. If you know a 5-year is trading at 10%, and you can even pick from the yield curve, When someone wants to sell to you at 8%, you say, no, but I saw the yield curve is priced at this. Then now information will ensure you, information is power, and to give you the capability for you to be able to protect yourself, and also read so many articles, get in information that are shared by different investment firms, go through them, compare them, even you do your own research, go to NEC, pick the yield curve, get all those things, put them together. From there, you form a picture and you'll be able to protect yourself from these rogue dealers. Number 3 is a green bond. A green bond is a fixed income instrument that are issued to invest in environment-friendly investment opportunities. A very good example, you can say, I want to construct a building. That's where I'm raising the money. But in this building, the source of power will only be solar. I don't want to do any other thing. So those are examples of green bond. We're investing in environmental friendly investment ventures. My perspective for next year in terms of fixed income investment environment is number one thing that dictates the direction of fixed income is the government appetite for debt, which now again, analyzing the budgets come into space so that you know the government is they need more money, they'll come to the market. Then now the next thing for you is to track that. So that number one, government borrowing determine how the fixed income space plays out. Number 2, look at metrics, leading economic indicators like inflation. And inflation, currency levels. You look at things like how is the policy they should make policy decisions being carried out? Is government, is the MPC more bullish? Is the MPC reducing rates? Are they adopting loose monetary policy when you put them together? So if you look at in Kenya, appetite for debt for government still high. It now means again, there'll be demand. It means by the demand for money will still be there. If you look at the currency playing around 108, the most immediate way of dealing with the currency is to increase interest rates so that you attract foreign direct investments. Look at inflation, is not bad. It's there within the band 2.5, 7.5, that's good. Look at interest rate, again, MPC has been more relatively stable. So if you look at all these indicators pointing towards fixed income environment, will be either stable, tending towards being rates slightly going up because of mainly the demand for debts from government to fund the budget.
Okay.
Those I'm done with this 4.
Okay. There was another one. Does SBM have interest at Genghis? Were you exposed at Chase Bank or did you suffer financially? I think that one you can, he's called admin. I don't know whether you want to answer it now. Then the other one was, how come we only hear of equities and shares for most periods? Do you have a preference for them? I think I can try and answer that for admin. I think when you're doing a comparison between fixed income, the other comparison would be equities. Yeah. Yes. Yeah, you can try and answer those 2, Maurice, for now.
So the reason why equities are more trending and people tend to talk about them is number 1, how much do I need to invest in equities market? I need to be able to buy only 100 shares. For example, if you take which stock is trading, let's say, for example, take CIC, trading at less, is trading at below 3 shillings. How much do I need? I need 300 shillings. No, in fact, I need exactly 300 shillings for me to buy minimum CIC shares. It's very easy. Now, when you come to fixed income for bond, I need 50,000 for me to be able to invest. So the reason why people don't talk about the entry level of is discriminative. And that's why you saw government was coming up with, it was called a Makiba, to democratize the process, the investment opportunity, so that now even these bonds are also available to the retail investors. So the entry point for equities are more friendly, easy for anybody. 300 shillings, I'll get 100 shares for CIC. But when you come to fixed income, for me to be able to participate in an auction, I need to get 50,000. To be able to participate in a treasury bill auction, I need 100,000. That's now what gave birth to the Makiba. 3,000 shillings, I can eat. So the next question was, does SBM have interest in Genghis? There's no relationship between SBM and Genghis. Genghis currently, as it is, it's owned by a company called Overtime Capital. And remember, Genghis was bought by Pamoja Capital. So the Genghis, as it is currently, there's no relationship with SBM. And there's no relationship even with the chase. Genghis was bought by Pamoja Capital.
All right. I don't know whether you can elaborate on how Genghis can assist investors trading bonds.
We can. Remember, I said there are two ways of doing it. Yes. Direct investments, which may not mean direct investments, I have to meet the minimum entry levels. I must have 50,000 for bonds. I must have 100,000 for treasury bills. Then the next thing, just need to open an account, and Genghis will help you open a CDS account at central bank that will now indicate your name. Then what remains there will just be sending market insights, information, recommendation, whenever there's an auction to tell you where you can bid at. That's number one. Number two is to give you a fund that exposes you to fixed income opportunities. Which example that I gave is the Helaimara fund, which is a money market fund. Invest in purely fixed income instruments. Minimum investment is 500 shillings. When you want your money, 2 to 3 working days, you'll be paid. I think now it depends on an individual. Do I want to go through the process of straight to an instrument, or me, I just want to get that return? And now coming through a fund is easier. Entry level, minimum entry amount is affordable compared to going direct. And again, coming under a fund, when I want to exit, is easier. I just place an instruction that now, that money I gave you, I want it back. Then just now start counting days, 2 to 3 working days, you'll have your money. When you are in direct, let's say you bought a bond worth 50,000, now you want money, that bond will have to be sold. And when you take such bonds to sell in the market, those bonds are called odd lots. Odd lot means it's too small that I can't even look at it. It's wasting my time. So it will be priced. Price will be at a discount. So I'll say, for me to deal with the thing you are showing me, give me at a good price. That's now the danger of investing directly in fixed income opportunities, and along the way you need money back. Most people, when they invest and they hold to maturity. So it depends with the type of investors and where they want to play in, because at the end of the day, people don't buy instruments, people are buying returns. You can get directly or through a fund.
All right. There's one last question. I think we have someone who's raised her hand, Agatha. I'm going to unmute you. Yes. You can ask your question.
No, I'm sorry. It was by mistake.
Okay. All right. One last question. How can I, as an investor, perform bond valuation?
You can. The only thing you need to understand how to do it. Once you understand once you know the concept, the only tool you need is a computer and an Excel spreadsheet. You'll be able to price. But the thing you just need to know, what are the building blocks? I need to understand this instrument. understand when was it issued, when will it mature, what is the coupon rate, what is the coupon payment frequency. Then I populate all this information in an Excel spreadsheet. Then I get a yield, I discount, bring them to now. Then from there, you'll price a bond any day, anytime. So the reason it's a complex process that you could not fit in this presentation. That's why I just gave out the building blocks and how you do it. But anybody, so long as you have a spreadsheet and a computer, you can price a bond.
I like the way you make it sound easy, Maurice.
Maybe you can look at it in the subsequent webinars. We just come so that we price a bond.
All right.
But just know building blocks. In fact, you need three things: the concept, understanding it. Number two, have a computer, get a computer, and that computer have a spreadsheet with that bar for formulas.
Okay.
You'll price a bond.
Okay. All right. I hope, James, you've been answered. I think for further clarification, we shall reach out to Maurice. We'll give you the details. I don't know whether there are any other questions coming through. Yes. So I think we have been in a fixed income class, basically, yeah, learning everything about fixed income. And thank you so much, Maurice, for being with us today. Of course, we shall be having you back to expound on the valuation part of it, especially that, and also how we can partner with Genghis to grow our wealth. Yes. You have
Thank you.
Yes. Asanteni sana all for joining us. I think we can end there. We shall share the presentation at the